Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First off, big banks expected to report record trading fees and positive outlooks for deal making in 2026, but many of their stocks are tumbling after President Trump threatened to cap credit card fees. What to watch when JP Morgan, Bank of America, Goldman Sachs, and more report this week. Plus, the Federal Reserve under fire as we await inflation data. Central Bank Chair Jerome Powell pushes back against a criminal probe that he says is politically motivated. This comes ahead of fresh consumer price data on Wednesday. And from Venezuela to Iran, geopolitical tensions triggering volatility in energy markets where investors can still find opportunities in that sector. Let's take a look at the major averages here. Now, initially, we did have stocks selling off to some extent after Jerome Powell came out in a highly unusual video message last night saying that he and the Fed were being targeted in a criminal probe from the Justice Department that he said was politically motivated because the president has pushed for lower rates. The president, for his part, says, I didn't know this was happening. Regardless, we saw a sell-off in stocks that is now abating to some degree. We've got the Dow right now down not even 200 points, about 0.4%. The S&P 500 not even down 0.1%. Same goes for the NASDAQ composite. If you look elsewhere here, of course, you want to look at what's going on in the bond market in the wake of something like this. And we are seeing a very small increase in bond yields on the 10-year, 30-year, ditto here. So a lot of people talking about being alarmed by this situation. We are not yet really seeing it play out in the markets, that alarm being expressed. We are seeing some hints of the so-called Sell America trade this morning, but it's not very dramatic. You've got the dollar under a little bit of pressure as another example. Bitcoin prices, again, down very slightly this morning. We continue to watch crude oil prices, not only because of the aftermath of Venezuela, but also because of increasing protests in Iran and questions about the outcome there. But crude oil now a little bit below $59 a barrel. And another thing worth mentioning is the one place where you really do see concerns being expressed in this market is the reaction in precious metals and gold, especially going up to new record highs as people go into that asset. In terms of the sectors within the S&P 500 on the move today, under pressure, the financials on that threat about credit card fees. We'll get more on that in a minute. Energy stocks as well, consumer staples and real estate. So a little bit of a defensive rotation happening today. I wanted to dig into the banks a little bit more right now. So I'm going to equal weight this so we can see what's under pressure. Capital One, which is heavily leveraged to credit cards, obviously under pressure, as is Citi. JP Morgan down as well. Some of the banks that don't have really as much credit card exposure, Deutsche Bank, HSBC, some of the European banks are trading a little bit higher. Barclays, though, does have a significant credit card portfolio, and those U.S. shares are under pressure. Let's get more on the banks now because they are set to report earnings for the most recent quarter this week. JP Morgan Chase will kick things off on Tuesday, and analysts are expecting record revenues, with one analyst calling for the KBW banking index to once again outperform the S&P 500. That would be the third year running. Clouding the picture, though, a new call from President Trump for credit card issuers to cap the interest rates they charge at 10%. Here with more on what to watch as the banks report, Gerard Cassidy, RBC Capital Markets analyst. And, you know, Gerard, I was planning on having just a straightforward earnings prediction conversation. Then we had a little bit of a wrench thrown into the works, as we have had a lot recently. And so I have to ask you first about this proposed 10% cap on interest rates charged on credit cards. It's unclear how and whether it's going to go into effect, but how are you thinking about what effect it could have on these companies?
Thank you. And you're right. We were hoping to have a more focused conversation about what the fourth quarter earnings, but this news certainly takes priority. And at this point, it's going to be very interesting because it's our understanding, obviously, through an executive order, the credit card companies are not going to be required to lower their credit card rates to 10%. It either has to come through legislation in Congress or codified through the regulators, similar to the Credit Card Act of 2009 that came through Congress. And so it is certainly weighing on the stocks today. Clearly, this president understands we're obviously have midterm elections. And as we saw with the election of the mayor in New York City, costs of living is a real talking point for the Democrats. And so if this is a way for the president to try to bring down, the costs for consumers, it's a political strategy on their part, but it would have real negative repercussions for many borrowers, because if the banks were actually forced to lower their credit card rates to 10%, certain borrowers would not qualify for credit cards and would affect the economy, and affect it, of course, negatively. So right now, it's in the early innings, of course. We're not, and as the stocks are now starting to recover a bit from the early sell-off, we do not expect this to go through, and we do not, it'll be political fodder for probably the next couple of months, but we don't expect anything to really come from this where the banks are actually forced to lower rates to 10%.
And Gerard, just to be clear here about why you think it would be bad for borrowers, I mean, basically, would you expect, if this happened, would you expect the banks to basically say, like, to limit the number of people who they would approve for credit cards if they can't recoup the cost of that risk through charging a higher rate?
You put your finger right on it correctly. And so you look at some of these card companies that have 5, 6, 7% credit losses. And if you lower the credit card rate to 10%, how are they won't make money. The cost of running their operations is greater than 3% of total of that yield. And if you've got losses, again, of 5, 6, 7%, you're barely going to break even and probably lose money in some cases. So why lend? And so there would be a real dialing back to the higher risk borrowers, who tend to be the borrowers on credit cards that revolve and use those revolving natures of those cards to get them through maybe more difficult times. So it would shrink the amount of growth in consumer spending, likely, because there'd be less originations of credit cards.
Okay, so that business aside, now we can turn back to the main event, which is looking ahead to some of these earnings reports. And I know one of the highlights is going to be the trading revenues. We've already gotten some hints on those, and just the capital markets business as well generally, which is expected to be strong. I guess the question is the sustainability of that strength through this year, Gerard. What are you expecting?
Assuming the U.S. economy continues to grow at around 2 to 2.5%, you probably saw last week, like many of us, the Federal Reserve out of Atlanta does the real GDP now forecast, which forecasts the current period's real GDP number. And so they, with the trade numbers that came in much better than expected on the deficit, they are now looking for 5% real GDP growth, which is obviously not likely. But the point is, we should see good growth in 2026. Let's call it 2 to 2.5%. Clearly, this administration, contrary to this credit card issue, they have been very supportive of many industries in deregulation, allowing M&A activity to go through. So I think what you're going to hear regarding the capital markets outlook is that investment banking pipelines for mergers and acquisitions remain full, even though we had a decent ECM market, equity capital markets, in 2025. The IPO market was not really that robust, and there are some big IPOs potentially this year. So I think you're going to hear about that as well. And then when it comes to debt capital markets, we had a record year in 2025. This year has gotten off to a very strong start. So I think you're going to hear some real positive comments about the outlook for 26. And trading is more difficult to predict. It's a bigger part of the capital markets revenue stream, and volatility certainly is what trading revenues benefit from. So we're seeing volatility obviously today. So I think the outlook for trading will be good, but the investment banking commentary should be real good. So I think you're going to see strong numbers in the fourth quarter of 25, and then the outlook for 26 is going to be good. But here's an interesting observation for you, is that the so-called second derivative, the rate of change, it's going to be increasingly more difficult for the capital market players to show really strong year-over-year earnings growth numbers in the second half of 26 to the second half of 25, because the comparisons for investment banking and trading are going to be really more difficult in the second half of the year than the first half of the year.
So when you hear a prediction, like I mentioned earlier, which I believe was from a Bank of America analyst, that for the third year running, the KBW Bank Index is going to outperform the S&P 500, do you think that's going to be challenging because of that second half?
No, we're in that camp. We've been writing reports about the period we're in today is very reminiscent of the 95 to 97 time period, where we had 3 years of great performance of the banks outperforming the S&P. We call it the trifecta. We are in the camp that is looking for this year, once again, that the banks will outperform the S&P 500 like they did in 24 and 25. And it's really driven by not so much the capital market, and that's part of it, don't get me wrong, but it's because they'll still be positive, just maybe not as positive in the second half of the year. But the bigger impact is going to come from lending. If you look at the Federal Reserve data on loan growth, if you look at the beginning of the year, the H8 data, as it's referred to, was showing growth of 1%. Year-over-year growth. Last week, it comes out every Friday afternoon, we're at 5 to 6% rate of growth. So we're going into 26 with loan growth 5 to 6% versus 1% going into 25. Plus the yield curve. If you look at the yield curve, the Fed funds rate now, let's call it 3 to 3.5%. Say we get the 3% Fed funds, 10-year stays above 4. It's been 20 years since we had a Fed funds rate over 3 with a positive slope of the curve of 75 to 100 basis points. That's very positive for lenders. So those are the reasons we feel that the banks will outdo the S&P 500, because it's set up going into the year quite positive.
Gerard, going into earnings, do you have a favorite pick that you think is just the one that you have to own? And do you have one that maybe is not going to be participating in the strength that you think investors should avoid?
The ones to own, two names that come to mind, Fifth Third and M&T Bank. Both of them are regional banks, and I think you're going to see they had strong quarters, but more importantly, their outlooks are going to be quite positive. Last week, of course, Fifth Third had shareholder approval of their acquisition of Comerica, so that certainly is going ahead as scheduled. And the M&T, I think you'll have better loan growth outlook. In terms of underperformance or maybe less positive, it's difficult to identify companies because, again, they're all should have some good numbers, and you wonder if the stocks have been so strong for the investment banks, even with the expectation of strong outlooks, coming up, could the stocks trade off a little bit where, it's buy the rumor, sell the news type of scenario for a Goldman Sachs or a Morgan Stanley. But the outlook for them, again, as well as JP Morgan, Citi, B of A, all of their capital markets businesses is going to be strong, no doubt about it.
Gerard, thanks a lot. Good to see you.
Thank you for having me on.
Take care. Coming up, what the DOJ probe into Fed Chair Powell means for the future of the central bank's independence. That's next on Market Catalysts. The Federal Reserve is facing what Chair Jerome Powell calls an unprecedented action. Powell revealing Sunday night that the Justice Department served the central bank with grand jury subpoenas, threatening a criminal indictment related to Powell's testimony before the U.S. Senate. For more on the power dynamics at play, let's welcome in Jason Furman, Harvard Kennedy School of Government professor and a former Council of Economic Advisors chairman under President Obama. Jason, thank you so much for being here. And I know you've signed on to a statement with some former Federal Reserve and other government officials emphasizing the importance of the Federal Reserve's independence. But I just want to take a moment and just get you to react to what we have seen in the last 24 hours, because it is so unusual, to say the least.
Yeah, Jay Powell did not want to get to this place. His statement last night was enormously powerful, precisely because he has stuck to his knitting, continued to do his job, not fallen for any of the debate. This is bait. This is not a resistance lib. This is a person doing what he needs to for the sake of the United States economy and our country more broadly. And I think he's going to win.
And is that belief, do you think, why we're not seeing more of a reaction in the markets? Or is it just because markets don't react necessarily to this kind of stuff, Jason? What do you think?
Yeah, I think this is backfiring. You saw Senator Tillis's statement. This is going to complicate President Trump's ability to get his person on the Fed. It's going to increase the likelihood that Jay Powell stays on as governor. I don't think courts and juries are going to go along with this. And for the members of the FOMC, it's going to make them want to stand up and show their independence too. So this is a very, very serious threat, but the Fed is a real testament to its success, and widespread acceptance and belief in that success, I think, will prevail.
Jason, do you think that Powell will stay on as a Fed governor after his term as chair expires, in part because of this?
I think it makes it much more likely that he'll stay on, and it would be a real sacrifice. It can't be fun moving from chair to governor. It can't be fun being at the Fed in the current environment. But unfortunately, it may be what he feels he needs to do. Every vote at the Board of Governors is critical. 4 out of 7 of them can remove any of the Reserve Bank presidents. It's, at some point going to become a matter of counting votes.
And Jason, recently you wrote in the New York Times just about the sort of dynamics at play, not just with the Federal Reserve, but all economic policy more broadly, and the president seeing some challenges to, from tariffs to his attempts to remove Fed official Lisa Cook from the board. So where do you think we land now in the wake of this latest action in terms of kind of unified economic policy and where we are?
Yeah, my argument in that piece was that we basically had seen peak Trump, that last year sweeping fiscal actions, sweeping actions on tariffs, sweeping actions through DOJ, and that we're just not going to see more of that. Now, he's going to try. He tried on interest rates with credit cards. He's trying now with Jay Powell. He's not somebody that's going to fade into the distance. We're going to be seeing and talking about him each and every day. But his ability to get things done depends on the courts, it depends on Congress, it depends on the law, and all of those are increasingly going to be skeptical of him, and I think that's what we're going to see on this particular action on the Fed as well.
And Jason, we have inflation data coming out this week. We have CPI coming out on Wednesday. And so setting aside economic policy for a moment, what's your assessment between the jobs report we got last week and what you expect for inflation of the economic backdrop right now?
Look, I was in Europe last week and they posted a 2.0% inflation. They're feeling mission is accomplished. Here in the United States, the mission on inflation is definitely not accomplished. It's a lot closer to 3 than it is to 2. GDP growth looks to be very strong. I think most of the weakness of the job market is on the supply side, not the demand side. So it's not something the Fed can solve. So to me, the risks remain tilted towards inflation, and policy should continue to be in a contractionary stance to deal with that.
So the Federal Reserve policy can't do anything, but on that front, on this sort of affordability front, which is the buzzword of the moment, the White House has been trying to make some attempts to address that, particularly on the housing side, saying Fannie and Freddie should be buying more mortgage-backed securities, saying that there shouldn't be private ownership of single-family homes, institutionally. Do you think any of those moves are the right ones, are in the right direction in attacking affordability?
Right. I mean, things like private equity owning homes will do about as much as spitting in the ocean will do about sea level. The big affordability issue that the president could solve is the tariffs. They're raising the price, including in housing, of construction materials. They're making it more costly to build houses. That's where he should start on affordability.
Are there any other measures that you think he could be taking besides the tariffs? I mean, one could argue that the tariffs aren't necessarily the only reason that we've seen inflation be persistent.
Oh, yeah, no, it's not. I mean, a lot of this inflation was set off 5 years ago by grossly excessive fiscal policy. One of the things that we worried about at the time was that it would perpetuate itself, where wage growth leads to price growth leads to wage growth. Unfortunately, the main way to address that is with tighter monetary policy, which is a bit unpleasant, but something our economy is more than robust enough to withstand, what with all the data center investment, booming consumer spending, and overall demand strength. So the Fed is central, but if the president wants to help out, he could get rid of the tariffs.
Well, it doesn't look like that's going to happen, Jason, on that front. What do you expect the Supreme Court to do on the tariff front? And it seems like even if they remove some of the tariffs, the administration has prepared other measures to keep some of them in place.
Look, it is partly happening, right? On things like beef and coffee, where it's incredibly visible and really hard to explain, the tariffs have come down. Some of the increases, like on furniture, have been canceled. So I think even the administration itself, while they claim the tariffs are paid by foreign countries, when push comes to shove, they're going to be pulling back on them. I hope the court invalidates a large swath of them. I think the administration could bring some of them back through other means. I don't think they could bring all of them back. And I don't think it's going to be in their interest to be raising tariffs. I think we're just going to see them, either because of the court, the administration, possibly, but much less likely Congress, tariffs going down, not up from here.
Jason, good to see you. Thanks a lot for your perspective.
Thanks for having me.
Coming up, we'll take a look at some of today's trending tickers. Stay tuned. You're watching Market Catalysts. Now, time for some of today's trending tickers. We are watching Warner Brothers Discovery, Meta, and Abercrombie & Fitch. Markets and data editor Gerard Cassidy is back with me now. And first up, Warner Brothers Discovery. Again, we got more developments here. Paramount Skydance is now ratcheting up its fight to take over the media giant. It's now launching a proxy battle trying to replace WB's board and launching a suit against the company in its ongoing quest to beat out Netflix.
Yes, and let's just back up a second and kind of big picture overview. We have two competing deals for Warner Brothers. One is from Netflix, and that amounts to about $27 per share. It's also stock plus cash. It's mainly cash. And then the competing deal is Paramount, and so that's at a higher price, $30 per share. But they're also buying more because the Netflix deal excludes some of the legacy cable products. And so the real value in Warner Brothers is the streaming and also some of the studio projects. So if you back up here, Paramount is questioning the debt transfer that's reducing consideration. What that has to do is there's going to be a final purchase price here that is ascribed to Netflix, and depending on how the company, that's Warner Brothers, is able to shift their debt from one side to the other, and that's the streaming and the networks versus the legacy, that could affect the final purchase price. And what Paramount is saying, there's not price discovery, or there's not a lot of transparency into that process. So Paramount is trying to derail or reopen the choice by saying, one, they're going to take their offer directly to the shareholders. Two, they're going to challenge Warner Brothers disclosures and decision processes in court, and that's that facet. And then three, they're also threatening a board proxy battle to block the Netflix deal or force deeper engagement with Paramount's bid. So all of this is just a lot more. I don't want to say they're heaping on more details into this already non-transparent process because they're trying to get more transparency. But suffice to say, this is kind of a confusing story here.
It continues to be, and we'll see who ends up winning the prize at the end of all of it. Let's talk about Meta as well. The company is announcing it's hiring Dina Powell-McCormick as vice chair of the company, and also she's going to be acting as president here. She's a former Goldman Sachs executive. She's also the wife of Senator David McCormick, a Republican senator of Pennsylvania. So interesting move that they're making here.
Yeah, so she would be building AI infrastructure and capital partnerships with governments, investors, and she does have those political connections. We just covered a story last week. Mark Zuckerberg and Meta are really scrambling for electrical power, and they're forging deals with certain nuclear names. Oklo was one of them. And so to get these deals done at the scale that they need, and there's nothing bigger than the scale of AI right now, and that's just only expected to increase, this could be a key appointment. Nevertheless, I don't think we're seeing Meta really respond that much to this particular news item. I think Meta's down about 90 basis points on the day. You can see on your chart there, that's a one-year chart of Meta. And since we have this chart up, let's just back up here. Here's a 5-year chart, and you can see over the last couple of years, maybe a year and a half, that it's just been in a giant trading range. And of course, this is that huge bottom that was forged after Mark Zuckerberg cut all those heads and finally established a new path for the company. But I think the company is looking, or investors are looking, for a new catalyst. And that explains this trading range here. So there's going to be a point at which the rubber needs to meet the road, and they're going to have to show results. But To be fair, is anybody showing huge results with respect to AI right now? At least not the hyperscalers.
Not huge, a little bit. And finally, let's talk about some of the retailers, and particularly through the prism of Abercrombie and Fitch. So a lot of these companies are coming out. There's a big retail conference going on, and a lot of these companies are coming out with preliminary results. Abercrombie is plunging after it narrowed its fourth quarter guidance. The share's down 18%.
Yes.
And it's interesting as it felt like in the holiday season, the expectations kind of had been ratcheted up around some of these retailers.
Yes, the K-shaped consumer, that's kind of been the story here. But I think a holiday, and I'm going to speak big picture because we got results not only from Abercrombie, but AEO, Urban Outfitters, Lululemon, even Five and below, which is kind of an outlier there. But here are some generalizations. Holiday demand looked resilient. Results are split. There's that K. Value sales were strong, but there is some cooling in apparel. Shoppers are still deal hunting and they are buying selectively. So it's not a case of that anything goes and you could just put it out there if you're a retailer and people are going to buy it. Multiple retailers, including Abercrombie, are flagging tariff pressuring costs. Even when the sales are solid here, this raises questions about who can absorb these costs versus passing them through. And then when you take a look at same-store sales, many of these are showing decent, mid to high single-digit gains, but they're not growing gangbusters here. So specifically with Abercrombie, the shares they're expecting fourth quarter sales growth of about 5%, and that's unchanged from the prior range. We're going to get those results on March 5th, but here's another stat. Full year sales growth now at least 6%, and it was 6 to 7%, so not a big change there. And then management said holiday sales were strong at Abercrombie and Hollister, but let's take a look at the Wi-Fi Interactive because I think the stock picture here is worth 1,000 words. I'm going to show you a 1 year. You can see it's down about 36%, but to be fair, let's show the 5 year. It's showing gains of 339%. Their big run up there was in 2023, 2024. They kind of plateaued, and then last year was when they kind of fell off a cliff there. They're basically,
although there was a run up in the shares, like sort of at the end of the year, right?
Let's take a look at the 3 month, and to be fair, that's up 40%. And then this is reflecting today, that big downturn, that's today. So.
And then if you go back to the retailers, to the apparel, Urban Outfitters also seeing a tumble, American
11.
Eagle, even though some of these numbers actually look pretty decent. American Eagle, for example, said in the fourth quarter, comp sales were up 8 to 9%. And we saw Urban Outfitters also saying that its comparable sales were up by 5%, but it looks like investors were looking for more in many of these cases.
Stay on this shot here. Let's do a 1 year, and you're going to see the K-shaped heat map that we have here.
Interesting.
You see some real big gains there from Real. It looks like Victoria's Secret, Ralph Lauren, AEO, which is down today, but nevertheless, and then you see some big losers there, down 40 to 50% as well.
Very interesting retail picture. Thanks so much, Jared.
Appreciate
it. Coming up, speaking of retail, why Walmart could be the next $1 trillion company. Stay tuned. You're watching Market Catalysts. Walmart could be the next company to join the $1 trillion club. Its current market cap sits just above $900 million, and the stock would need to rise by about 11% to hit that $1 trillion milestone. Yahoo Finance's Josh Lipton spoke to Michael Lasser, UBS food retail analyst, about the company's path forward.
Michael, always great to see you. So we asked you, could Walmart be the next $1 trillion company? We're already sitting here, Michael, at $913 billion, the stock up around 25% over the past year. Maybe you start here, Michael, just interestingly, what's been the shift at Walmart over the last few years that helps explain this run, that helps explain why we're even having this conversation? What changes did the C-suite make here in terms of priorities and strategies?
Thanks, Josh. There's two things that have changed that have resulted in this really good financial performance and stock price performance for Walmart. Number one is the company had invested significantly throughout much of the 2010s in areas like e-commerce, click and collect, building some foundational businesses, and it is starting to see a magnificent payoff on those investments. And two, the retailer is generating consistent performance at a time where the rest of the retail sector is experiencing significant volatility. So it looks like an oasis in an otherwise challenging environment. We think that the result of those factors means that Walmart stock continues to grind higher.
You mentioned e-commerce, Michael. I'm just curious how you see e-commerce as a market now, but also evolving from here, Michael, and what Walmart's role and opportunity is going to be there versus an Amazon.
So e-commerce is going to continue to grow. There are certain categories that are driving the growth in e-commerce right now, such as food, consumables, and the penetration of those categories should continue to rise. That favors a retailer like Walmart that has 20% market share of the U.S. food retail market. So we think the consumer is showing a propensity to want to shop for these categories through Walmart, and it's going to maintain this 20% plus e-commerce growth for an extended period of time. So we think that Walmart continues to have legs at this level.
I know you don't cover Amazon, Michael, but I would love just your response to this Bloomberg story I saw today. I don't know if you saw this. Just as it relates to Walmart, they said Amazon planning a Walmart-style big box store near Chicago. They're going to sell groceries. They're going to sell general merch. A fresh attempt, Bloomberg says, at physical retail that borrows from the big box store model of rivals like Walmart. What do you make of that, Michael, as a guy who knows this space so well?
So as someone who knows retail very well, I think the fact that competitors are coming into the physical big box environment validates how important it is to have a physical presence when you're dealing with this retail sector. So if anything, it validates the position that Walmart's already in. And it's going to be hard to catch up because Walmart's got 4,600 physical locations across the United States in great real estate and a really deep relationship with the U.S. consumer. It's hard to supplant.
What about Walmart's new CEO, Michael? Your thoughts there, and what are his priorities going to be, Michael? Like, if I'm an investor in Walmart, what am I watching? Is it investment? Is it cost discipline? What's on your radar?
So I think the transition to John Furner from Doug McMillon will be very seamless. They come from a very similar school of thought. They're aligned in their priorities. So I do not expect any significant changes. With that being said, what I do think will be important from here is near-term execution remains at a very high level. That's one of the factors that has driven the stock to the level that it's at. And two, Walmart continues to plant the seeds for the future. Obviously, artificial intelligence and areas like agentic commerce are becoming more important. And Walmart's going to have to change and evolve to continue to meet the dynamic retail landscape. And I would expect that John Furner's leadership will be quite solid in that area.
Michael, I'll get you out of here on this. I know, listen, you're a Walmart believer. You tell your clients this one's a buy. What are the big risks, though, I need to think about in 2026, Michael, and beyond? Is it, is it execution? Is it competition? Is it some risk that we're just underestimating right now?
I think it's all of those factors. The state of the consumer is a big one. There is some enthusiasm that the consumer is going to be better off this year for fiscal and monetary reasons. Walmart should benefit from that, but that is a constant source of uncertainty. Two, Walmart's gained a lot of market share in the last several years and might have to reinvest some of its significant profitability potential back in driving the top line. That remains a source of unknown. And then three, execution remains a source of risk and uncertainty for any retailers, especially one the size of Walmart.
Michael, it is always great to have you on the show.
Coming up, the outlook for energy amid rising geopolitical tensions. Stay tuned. You're watching Market Catalysts. We're watching Alphabet and Apple right now, and that's after CNBC reported that Apple would be tapping Google's Gemini to power AI features for Siri. This follows on a report last summer that said the two companies were in talks. That report came from Bloomberg. Now, CNBC is citing an internal memo from the companies as saying this partnership is happening. Now, in the wake of this, when this headline first crossed, we saw Apple and Alphabet shares spike a bit. Alphabet briefly surpassing $4 trillion in market cap. Remember, becoming only the third company after NVIDIA and Apple itself to rise above that threshold. Apple shares were up, remember, about 8.5% last year. Alphabet shares did much better last year as well, so about 65%. So we saw an extension of those gains. Right now, the stocks are a little changed again, but as we know, one of the big outstanding questions for Apple has been how is it going to integrate AI features into its devices. So perhaps this goes a little bit towards answering that question. Stay tuned. We'll be following these developments, see if we get any more details on it. And we'll be watching, of course, the stock reactions as well. Well, oil prices are retreating a bit as investors are watching yet more political upheaval, this time in Iran. President Trump said he is, quote, looking at military action as an option in response to crackdowns on protests in the country. Joining me on this, Ben Cook, Hennessy Energy Transition Fund portfolio manager. And we're seeing WTI a little bit lower, but Brent a little bit higher. But Ben, it's been really interesting between Venezuela and now potential for change in Iran to not see that much change in oil prices. Have you been surprised by that? And do you think that that's going to continue to be the case?
Yeah, again, thanks for having me, Julie. I appreciate it. The move in oil recently, I think, is reflective of just maybe a moderation in the bearishness that we've seen, the potential for disruption that comes with either protests in Iran or potential disruption in Venezuela associated with the removal of Maduro. The reality is, though, is that the crude oil market is well supplied. And if you consider the continuation of OPEC's unwind of production curtailment and the growth we're going to see in non-OPEC countries like Guyana, Brazil and Canada over the course of the coming year, I think the muted price action here is a function of the expectation of an adequately supplied market. So not really a big surprise.
So you look at specific companies. That's what you do. That's what your job is. I want to ask you about one specific company, and that's ExxonMobil, because as we know, some of the oil executives met with President Trump last week. He's encouraging them to invest in Venezuela. And Darren Woods, the CEO of ExxonMobil, said Venezuela is uninvestable, right? They had invested there, had their assets seized. They've been fighting to get reimbursed for that for quite some time. And then President Trump sort of lashed back out at him. I mean, do you think that is an investing risk for ExxonMobil at all, this sort of back and forth about Venezuela?
Well, honestly, I think there's probably no better person or company, for that matter, to speak on the investability of foreign countries than Exxon and Darren Woods. I mean, they operate globally, places like Africa, even Papua New Guinea, some frontier areas around the world, and they're well aware of the risks and managing those risks and bringing large-scale developments online. The reality is that Venezuela holds great promise. I mean, the country was producing 3.5 million barrels a day before Hugo Chavez took over. And, longer term, I think, in order to revive the industry and grow production volume back to where it could be, Darren makes some very strong arguments. Look, we need safety guarantees. We need to ensure that personnel operating in the region are going to be out of harm's way. We need a legal system that promotes and protects the sanctity of contracts. And we also need a financial system that's transparent. We need to be able to follow the fund flows from investors into the projects that get developed and ultimately see the revenues make it back to the people of Venezuela, as well as the investors that have put that money at risk. So, is there a risk for Exxon? I think they have a great portfolio of international assets. When the time is right and the risks are appropriate, they'll make the right decision.
Ben, leaving Venezuela aside, you like shares of ExxonMobil, right? And I'm curious why and what you think the sort of outlook is here. Energy stocks, I mean, Exxon did okay last year, but energy stocks sort of broadly have not really been in favor. So why do you like Exxon here?
Yeah, we like Exxon for a couple reasons. The integrated business model affords flexibility and commodity volatility. If crude oil prices are weak, typically the refining business can make up for that weakness given the lower feedstock costs, the better profit potential in the refining business. They also have a very attractive chemicals business, petrochemicals business that stands to benefit from low-cost feedstock as well. The company has a very strong balance sheet and obviously a management team that has demonstrated capability in investing through the cycle. And I think from an investor standpoint, one of the most attractive elements of the story really has been the shareholder return profile of the company. They pay an outstanding dividend that's been rising over the course of history. They also have a buyback plan that's robust. The stated plan is to buy back $20 billion worth of shares in the coming year, and will likely do so over the foreseeable future as long as Brent crude oil prices stay in the $60 to $65 range. So, we like it. Quality of assets, balance sheet management, as well as shareholder return profile is very attractive to us.
Ben, I'm curious how you're thinking about, your fund is called the Energy Transition Fund. Are we still doing the energy transition? Is it still happening? And, these companies have, in some cases, invested quite a bit in transitioning. So where does this leave them?
Yeah, we've been undergoing a transition in the energy sector for decades. If you look at the shift away from coal towards natural gas and the proliferation of utilities in the primary fuel mix, the potential growth that comes with nuclear longer term, every day we're shifting towards a lower carbon intensity in terms of our consumption. And we think that's going to continue. For us, in terms of managing the Hennessy Energy Transition Fund, we look for the best opportunities on a risk-adjusted basis. So, for us, we continue to like the hydrocarbon space, given the cash return profile for many of the companies in our investable universe. Renewables will continue to make up a significant part of the primary fuel mix, and we'll continue to see growth in that area. We've preferred to steer away from some of those companies given the policy risks associated with the Trump administration's potential rescinding of favorable tax incentives, the impacts of tariffs on foreign sourced components. Those are issues that we prefer not to, risk we prefer not to navigate. But over time, the market can change and the landscape will change. And the Energy Transition Fund and the broad investable universe that we're able to choose from provides ample opportunity to generate fairly consistent return going forward.
Ben, thank you so much. Appreciate it.
You bet.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching.